You're listening to the Childfree Wealth Podcast. We're your hosts, Bri and Dr. J, certified financial planner. Here we discuss life and finances as it relates to being child-free. This podcast is for educational and entertainment purposes only. Please consult your advisor before implementing any ideas heard on this podcast.
All right, Childfree Wealth listeners, if you listen to our last podcast on the John Bogle book, Little Book of Common, I could never get the damn name right. Little Book of Common Sense Investing, whatever it is. I don't care. But the point was, the book was talking about fees. And Bri and I have been dealing with fees lately with clients. And I thought we would do this a podcast topic just so I can spin Bri up. Because, man, you missed it offline. We've been looking at clients' portfolios and fees and diving in, and Bri lost it one day, and she was like, how is this legal to charge these fees? Is that fair, Bri?
Yeah, that's fair. If you saw some of the fees, and just for people who haven't worked with us before, what we'll do is we'll go and we'll list out all of the different funds you have or different stocks, and then we'll put the fees right next to it, the percentage, and we'll figure out what that is in dollars too. Pisses me off is a nice way to say it.
That's okay. I'm with you, Bri. And here's the thing. We're going to talk about fees, and you're going to then go look at your investment. And you're going to figure out you're paying a lot of fees. That's okay. Don't beat yourself up. Just fix it for the future. I'm just starting with that because most people don't realize what they're getting charged or how or where. And it's just one of those big issues. But I'm giving you a little break that, hey, right now your structure might not be right. It's okay. And sometimes you can't get around the fees. So, for example, in your 401k, you have very limited control on which funds you can pick. And I've seen some where I'm like, I don't like any of these funds. I don't like any of their fees, but these are the only choices you have. We're going to pick this one. And that's where people are like, wait, what? And I'm like, yeah, if we put it in your IRA, we'd be paying a whole lot less. And we get stuck. Sometimes that's the case. We're going to include in the show notes links to a couple different things. One is actually a notice from the Securities and Exchange Commission that outlines fees. They put out a notice a few years ago now. It said, hey, you should understand what you're paying, and you should know it up front. And I don't think people sit around reading SEC guidance. I mean, I do, but other people don't. It gives you a good view of it. The other thing we're talking about is we're going to talk about two specific kind of companies, funds, because we've seen them a lot lately. I am not picking on them specifically just because the heck of it. They're just because we've seen them recently. They're not better or worse than others. Actually, there's much that are worse, but we'll go with that. But we're going to talk about American Funds, which is Capital Group. We're also going to talk a little about Edward Jones, just because their fees have been ones we've run into like multiple times over the past month. And I'm just got Bri on a soapbox about these. Use your own judgment, but we're going to use the real stats. So, Bri, you outlined, you actually had some stuff at Capital Group American Funds for a while, didn't you?
I did. It was stuff that was started and given to me. And then as I got older and I realized it, I went then opened up my own things with Fidelity, did something else, did a lot lower fees. And moving my stuff from American Funds Capital Group to Fidelity took a year. It was that big of a pain to do it. And then when I moved it, I was like, I don't think I can touch this, or what do I do with it? I sold all of it. And my God, the day I sold it, I felt so good, especially after seeing all the fees. And now I just have low-cost index funds instead there. But man alive, I had it because I've said before, I grew up in South Dakota, very small area. You go to the person on the corner, you go to the person that you know from church, and that is how you do things. There isn't a lot of information, or information spreads very slowly. The people who set it up for me just didn't know any better. Like, it's not their fault. I don't blame them, but it makes me sad that I feel they were taken advantage of, and I think people who have these funds are often taken advantage of.
Yep, and you'll see, we've got the data. We're going to include links. We're going to show you all the numbers. These are not numbers we're making up. We're going to talk about American Funds. We're talking about Edward Jones because they're everywhere. Like, they're in the hometown areas. I'm in Mississippi in the middle of nowhere, and there's still an Edward Jones office right down here, and that's where you go because it's right there in the square, and you do your thing. But then you're going to pay a whole lot of fees. Mm-hmm. And that just is what it is. These fees don't stop. We're talking about fees that are the entire time you're investing with a company, the entire time you're working with them. And if you don't realize it, you could be making very little, to the point where the market could be doing great, but you're not, because all of it's being taken up in fees. So a couple things just to give you a little background. When in the financial world, when we talk about fees, you'll hear us talk about BIPs, BPS. Well, the way it works is 1% is 100 BIPs. And I say this because it's really hard and confusing to talk about 1% or 1/10 of 1%. 1/10 of 1% is 10 BIPs. 1%, 100 BIPs. So we're going to use that throughout. We're going to talk about percentage and BIPs. So just give you a context. And the going rate, let's call it that, in the industry is for somebody who's charging assets under management. It's a percentage of your assets just to exist is 1% or 100 BIPs. Just to exist. Now that means you're going to pay 1% every year for the rest of your life. And the SEC Investor Bulletin actually did a little analysis of this and talked about, hey, over 20 years, how does this have an impact? And it's interesting. They looked at over 20 years. If you started with $100,000, the 1% fee would be almost $28,000 in fees. But if that $28,000 in fees was invested instead of paid to a company, you'd actually earn an extra $12,000. So really, that 1% ends up in almost $40,000 difference over 20 years, which doesn't sound like much, but I don't know about you, but I don't have an extra $40,000 to give away. What do you think, Bri?
Yeah, I definitely don't have an extra $40,000 to give away either. I've laid out some of these fees, and depending on how much you invest, let's say you just want to invest $100,000 and you're going to go buy an American fund. Many of them have a 5.75% float fee, which means that is what you pay to purchase it.
On top of
Yep.
the annual fee.
Correct. Which are often half of a percentage. So 56 bips was one of the last ones I saw. And an additional fee called a 12B1 fee, which is a marketing fee of another 25 bips, 0.25%. So there, you're nearly at 1%. Plus you have that additional management fee. Add that up and that can easily be 6.5 to 7% in fees right there. And you could pay us one-on-one for a year and still pay less in fees for that.
Yeah, and by the way, this is not about selling our service. We picked the advice-only model because it fits child-free folks, and we don't believe in charging a percentage fee. That's just kind of how it is. But what happens is I actually have, and we will link to Capital Group's outline of their fees. And here's what they say. They go, well, the fees are designed for people who choose to compensate their financial professional based on, and I'm like, wait a minute. Okay, you choose to compensate? I'm like, oh, that's marketing speak that I'm just going to lose my mind over. But yeah. Here's how this works in the financial world. You can do what's called fee-based. We charge you a commission, and we don't charge you money out of pocket. Bri was talking about the fees, and this is where we're going to fee-based. She was talking about American funds. This happens to be a Class A share. They charge 5.75% up front. They don't charge you a fee to your, you don't pay on your credit card, or you don't pay them a fee. You're actually getting charged. They're just hiding it.
Yes. And
that's in the fee-based commission world. Because they say, well, it's no cost to you. Mm-hmm. Well, I want to give you a little lesson here. If it's no cost to you, you're getting charged somewhere. Yeah. I'm just telling you. I don't care. They're not doing it for free just to have you as part of their team. Mm-hmm. You with me, Bri? You look like you want to jump through the screen on me on that one.
When I was 22, I think it was, and one of my first jobs out of college, I set up my retirement account, and I asked the guy when he got there. First of all, the guy was a jerk. He walked in, he was like, do you even know what a retirement account is? That was the first thing he said to me. I was like, well, hello to you too. And yes, I do actually, I've been doing my own stuff, and I was like, actually, and I'm only doing this because I'm getting a match. Otherwise, I wouldn't want to deal with you. We started off on a great foot. I am not afraid to tell somebody if they are being a jerk and be a little confrontational. So I was. And I asked him how he got paid, and he told me, well, we don't charge you anything. I was like, you're lying to me. And then without even asking me what my goals were or anything, he had this whole multiple sheets of paper, and he highlighted a couple things. He goes, this is what a lot of your coworkers do. That made no sense for me. Like, I'm not like any of my coworkers. And he just told me he didn't do anything. I finally got my stuff out of there. I waited the time to roll it all over, and I'm very happy because I did not like him.
Yeah. And you ever wonder why people don't like financial advisors? So keep in mind, by the way, people can call themselves a financial advisor without being a certified financial planner or having any certification or even being an investment advisor. You can be a financial advisor and just be selling insurance or other products. Yeah, I understand it. It's a pit of snakes. Okay, so I got to admit this. So I talk to people, financial planners all the time, and I actually spend most of the time talking about child-free folks, of course, so you're not surprised. There are some meetings I'm like, dude, I would never want to be in the same room with you, because I meet via Zoom. I'm like, I got to go take a shower because you're like slimy. It's usually those ones, by the way, that say to me, well, if you charged a percentage of assets, you'd make more money off your clients than you do as advice only. I'm going, yes, I would. Is that a bigger value for my clients? No. Am I doing more work because they have more assets? No, I'm not. The numbers changed, but the work didn't. There's a place for paying fees, but they got to have a value. All right, fee-based, they hide it. So now we go in a world called fee only, which is I only charge you a fee, but there's some caveats here. That percentage-based AUM person is fee only. They're charging you a percentage of your assets every year. I just grabbed Edward Jones's numbers. They're publicly available. They have different models. One is based on commissions ranging from 0.99, so 99 bips to 450 bips. Or they have their assets under management, which is an annual program fee of 1.35%, which is 135 bips, with lower tiers if you have a whole lot of money with them. So we're talking about a large number of percentage of your fees. But here's what they also say in there. It also says some investments have third-party internal expenses, which is a nice way of saying we can also sell you funds that have other fees. So when we talk about investing, we had talked about a simple 3-fund portfolio, the whole U.S., the world, and some bonds. That one adds up to about 10 bips of fees, 1/10 of 1% or less. That's a whole lot different than a fund that's charging you 1% just to exist, or 5.75% up front, or whatever, and then an asset fee. And that's the problem. So people go, well, I went to a fee-only person, so it should be better. By the way, it is better than a commission-based one. I'm going to go on a limb there and say it's better in most cases. But there's a big difference between fee only, that's either what they call flat fee, like you pay them X per year, they do everything for you. I'm okay with a flat fee because then I know what I'm paying and I pay for it myself. I'm not charging a percentage versus I'm going to give you a percentage of my money for the rest of my life. And here's where I have a problem for child-free folks. I believe the percentage-based AUM model has a conflict of interest with people who want to die with zero. If you go to somebody that's charging you, so we were talking about Edward Jones, 1.35%, 135 bips for your assets, they want your assets to always go up. If you're child-free and trying to die with zero, you want your assets to go down. Guess what? The advice they give you might have a conflict of interest in there. This is the problem with fees. The problem with fees is you got to know what you're buying and what's behind it. So the commission model, the fee-based, they're actually getting paid to sell you stuff. I was going to say crap, but yeah, crap. They're getting paid to do that. And actually, there's some issues, and they've had some places get hurt for this. They call it churning. We're like, hey, I'm going to sell you out of this and buy into this. And they do it too frequently just because they get a commission every time it goes by. The Bogle approach, you set it and forget it. They're earning commission once and not ongoing. That doesn't help them. I think the hard part of that is you don't see those fees. They don't tell you about them in Bri's example.
Yeah. I would just get statements and I would say, okay, it went down this quarter here and there. And it's like for the past couple years with the whole retirement account for my previous work, I haven't talked to the person in a few years, but I was still paying him every year simply because I had to. And as soon as the law allowed me to get out of there, I did. Because I was like, he didn't help me. I talked to him that one day when he was a royal jerk, and that was it. Now, not everybody is a jerk who does this, but in this case, this guy was. And I don't think I could sleep at night if I, even talking about this, sometimes I don't sleep because I get so upset.
And I get upset too, because the issue is a whole lot of people are being taken advantage of.
Mm-hmm.
Even like people go, okay, I went for a fee-only fiduciary, which is, by the way, is good. Fiduciary means, they have to watch out for you first and They have to actually put you first, versus a broker, by the way, is not necessarily a fiduciary. They can be just what's called a best interest standard. But you go to a fee only fiduciary, and then you go, oh yeah, but I'm still paying all these fees on top of it. It's just like more transparent. And I go, more transparent isn't completely transparent. That's the difference. Somebody comes to us, right now our monthly rate is $500 a month. We teach them, they get an hour with us, an hour offline. We help them with their investing. We'll tell them what to do. It doesn't matter if they have $1, $1 million, or $100 million. Mm-hmm. Now, if they have a complex situation, they may have to buy some extra hours with us so we can help them on it. But you know what you're getting. That's the difference. Advisors go, well, I want to charge you a percentage fee because if you make money, I make money. Okay, that's a logic. But it also means the more you make, the more they take.
Yes, that is one of the chapters in Bogle's book is the more investors make, the more managers take, which is the less investors actually earn.
Yep. That's why I'm okay with flat fees. If you want somebody just to do it for you and you want to pay them a flat fee, I'm okay with that. But a percentage based, not so much. And the problem is they're all out there. Let's walk you through this. We're going to actually look at a fund and show you this. We're going to look at, the ticker is AMCPX. This is American Funds, one of their big fund, let's call it that, growth fund. And we're going to look at the fees. American Funds AMCAP, which is their big fund. And that has different tickers depending on the structure. AMCPX is a specific A share, which means you pay the funds up front. And here's how this works. So the first fee you pay is a front load fee, 5.75, 575 bips, just to have it. If I buy $10,000 worth of it, they're going to take 5.75% out of that day one just for me to get the fund. But here's what happens with that. So now I actually start in the whole 5.75%. So to get back to my initial investment, I'd actually probably have to make almost close to 7% just to make that money back, because I'm starting at a lower number. So that's front load. Then they have expense ratio. Expense ratio is like, hey, we're running the funds. This is active funds, so they charge fees for that. This happens to be 67 bips, 0.67. And that 67 bips, you're going to be paying that every single year just because. Now, on top of that, the 12B1 fee that Bri mentioned. So 12B1 fee is a marketing fee for funds. Now, in a 401k, when you have mutual funds, you'll see these 12B1 fees. Part of that is to pay the fees for the 401k. But this is 0.24 bips. So what that ends up being is I'm going to pay 0.91 bips for my expenses just to have that fund every single year on top of paying 5.75 to come in. That fund better beat the market by a hell of a lot for me to be in it. And by the way, it doesn't. I just can't justify that every year in coming in. Now they go, well, but they have this long chart, and we'll include this also in the notes. You know, the 5.75 is only if you invest less than 25 grand. If you less than 100,000, it's only 3.5%. But wait, why am I paying you 3.5% for the honor of owning your fund? Mm-hmm. This is where I start losing my mind on top of the annual fees. What are you thinking, Bri?
Oh, if you are listening to this and not watching, you're missing the fact that I'm sitting here trying to restrain myself and biting the inside of my cheek because this makes me so mad.
You know, it's got a point now where, Bri and I will review clients' information. I'm like, Bri, they have your favorite fund. And she's like, yeah. And she just starts getting cranky at it. And we can add up the fees and every year and structure and working that through. And with thousands and thousands and thousands of dollars going away. Mm-hmm. People go, well, but I was told I needed this fund. And I'm like, yeah, I can do the same exact thing with an ETF for less than 10 bips and have no upfront fee.
Yeah. And do some of these advisors present options that are lower cost? Yes. But have I seen it where it is presented as the absolute last option out of all the options they presented? Yes. What have they given as the first couple options? American funds or other high fee funds.
And usually, by the way, those are actively managed mutual funds. There are a few ETFs with high funds, but they tend to be rare. Let me actually show you the alternative. So actually, for American funds, they have one AMCAP version C, which has a ticker of AMPCX, which does not have a front load. Instead, it's got deferred load, where we're going to charge you 1% when you sell. Now, here's the thing on that. That means after it grows, they're going to charge you. So guess what? The math works out pretty similar. But on top of that, the expenses go up. So now the annual fee, the expense ratio is 1.43, 143 bips. And the 12B1 is 1.00, so 100 bips. So you're paying 243 bips a year in fees, but you save the 5.75 up front. That really just sounds like, hey, I didn't screw you on the way in, I'm going to screw you on the way out.
Yeah, exactly. It is.
Now, by the way, there might be a place you might be able to prove to me one of these funds has a long-term return that's better than the market, and the fees are worth it. There might be one of those. I haven't found it yet. It's just like, I'm going to admit, I might be missing something because I don't believe in paying fees. The only fees, and I mentioned this in previous, I pay a little extra on my ETS because I do ESG funds, so they have to select, but it's an extra like 10 bips. It's not an extra 150 bips just to have a fund. You have to, if you're buying a fund with fees, you have to be getting something out of it. And that's where I go, I don't know what I'm getting out of this fund. And somebody will probably, like in the comments, beat me up and say, oh, well, over this time period, this did better. Okay, yep, you're right. If you cherry pick a time period, that fund did better. But you got to overcome the fees just to say hi.
Yeah.
And by the way, in many cases, that's on top of the account fee.
True. There's a lot of fees. I don't think that they are fully disclosed to people and explained in a way that makes sense.
Okay, so let's get technical on this. They are disclosed because they provide a prospectus, which includes the fees in there.
But in a way that people understand.
Well, hold on. That's a different argument.
That is, yes, they're given it, but do they understand it?
Well,
that is my thing.
So, all right, I bought new headphones, and there was like a 3-page agreement just to like turn on headphones because I guess, I don't know, blow up my ear or something. I don't read it all. I'm going to be honest on that, and you wouldn't either. The prospectus comes to my house, I throw it in the trash.
Okay, but when it comes to money, like, it's irresponsible for somebody to sell you something and not explain it to you in a way you understand.
Okay, well, so here's the thing. This is where we get into morals, ethics, and legal battles.
Yes, and I think that a lot of people don't have that great of morals when it comes to this.
So, all right, here's what's happened. Over time, the SEC, by the way, we got like rules we got to follow for everything. I mean, I got to keep every email ever, and I got to do all this stuff. And they've made these forms. It says Form CRS, which is the Customer Relationship Summary, and they have the prospectus and all. They made these forms, which outline every thing, hey, this could go from good to bad, and the world could come to an end, and all this crap that nobody reads because it's gotten so long. All right, at least that's my theory. But what happens then is they go, yeah, I trust my financial advisor. I'm just going to do this. My answer when I talk to clients, we send them homework. Read this, do this, look at this. Now, if they don't do it, I have no way I can't force them to do the homework. But we want them to be informed, not just take our word for it. And what happens, though, is some of these, and we haven't even gotten into fees of annuities and insurance products and life insurance. Oh, you want to see fees that are hidden. We'll have to do a separate episode on that. But they don't explain it because then you wouldn't buy it. Now, the hard part of this is brokers are held to what's called a best interest standard. And this gets really weird, so bear with me for a second. Some firms are both brokerage firms and registered investment advisors. When they're brokers, they're held to a best interest. When they're registered investment advisors, they're held to a fiduciary standard. How you split the difference, I have no clue. We're a registered investment advisor. We're held to a fiduciary standard, which is a higher standard. But you have to explain these and work this through. And now, best interest, though, the weird one is I think it's in Bri's best interest to buy this one with the fees because I believe this. Now, the hard part is, I can't say, well, your belief is wrong, although the data says you're wrong. But I really can't. The problem is with finance, any thesis on finance works. You're like, I think it's best if we invest in orange futures and commodities. Okay, I don't agree, but that's a thesis and it works and you can try it. And that's okay. You can justify it to a client. Somebody's saying, hey, I prefer active managed funds because of, I don't know why, but let's just go whatever the reason. They can say it's in somebody's best interest. That's the problem.
Yeah.
The other problem is if they follow the BOGO approach and just 3 funds set and forget it, they make no money on it.
Yeah, and that's fine. It's okay to not make a ton of money by screwing people with fees.
So, Bri, hold on. I got to call this out. We're going to share a little inside baseball here, a little behind the scenes. Bri's been with me now, 4 or 5 months. We've been working on different things. We did a informal interview, let's call it that. It wasn't really a formal process. I said, Bri, come work for me. I will train you how to do this. I will make sure you've got the best training. You'll be the best planner you can come to. I don't pay well. Isn't that what I said, Bri?
Yeah, that's what you said.
And by the way, she took the job anyway. We'll have a separate discussion on why she took a job that doesn't pay well. But here's the thing. The advice-only model and the structure we have, it's not the best way to make money. But it's the best thing for the client.
And I feel good about myself. I feel like I'm actually helping people.
Yeah. The reality check is that the fees, the financial incentive is to charge more fees and percentage-based, not to serve the clients.
Yeah.
Ever wonder why Bri and I get all fired up about this?
Yes. I've been holding this towel underneath my desk in my hands, wiping the sweat off my hands because I'm so frustrated with this. And I'll probably have to take a walk after this because it makes me so angry.
Yep. And now, by the way, I just picked 2 funds, and I'll pick a fund and a company randomly. I can pick any company and fund you want. You go on one of those apps that's fun and the fireworks come out when you buy stuff. Guess what? You're paying fees.
Yeah.
You just don't know what they are.
Exactly.
That's what they're doing. If we use the apps as an example, because generations have changed, they're trying to convince you that it's fun to buy and sell stocks because guess what? They make money every time you do that.
Mm-hmm.
And by the way, they're hiding it better. Now they get this payment for order flow and a few other funny things that are going on, but they're getting paid every time you do that.
Yep.
Why are they incentivizing you to do this? Because they're getting paid off it. That's the problem. This is why the set it, forget it works. Whatever the minimum fee I have to do to do it, as low as possible. Fidelity's right now trying to do some 0% fees on a lot of the index funds. Now, by the way, they're still making money somewhere in there on the buy sell of it. Let's be real with that. But that's where we're heading to, is something close to 0. People go, well, I don't pay a commission. No, but you pay the spread in between what you buy and sell at. That's just the commission hidden. They're just getting better at hiding fees. Here's the thing.
Yeah.
If I buy an ETF and just hold it for life, I pay that, 10 basis points, 8 basis points, whatever it is to have that fee, that fund, and that's it. I'm not buying and selling. I'm not paying a fee every time I do this. I'm making out.
And it shows in your numbers too.
So we're going to include some links. I will tell you, if you want to get Bri fired up, just next time you're having a cup of coffee with her, ask her about investing fees. She might throw a cup of coffee at you. But
I won't do that. I will be nice. I will just say, know your fees in a very stressed voice.
I will tell you that there are a lot of financial planners that will challenge me, and the running joke has now become, hey, if you're advice only, a vegan, and you do CrossFit, which do you talk about first? And I'm like, well, being advice only, of course. No, but anyone knows me, I am not a vegan. I'm a meat eater. But, I talk about it because I believe it's right for clients. The only fees I'm okay with, if you're doing asset management, is a flat fee because you know what you're paying for. You pay for it. I still think you can do most of it yourself. But if you need help, cool, you pay somebody a flat fee. You can do this. You pay X amount per year or per month or whatever per hour, and that's it. That's how you manage your funds, and you learn. And by the way, investing is the easiest part of financial planning. So we really shouldn't be paying fees for that. We should be paying fees for the other services, the other financial planning, the tax planning, the insurance, the life planning, all that stuff. Here's your homework. And by the way, this is going to probably piss you off, so I'm warning you in advance. You go into your app, whatever you're tracking your investments on, your 401k, your investments, whatever. Grab a Google sheet, list every ticker, put a column, what percentage fees, and do the math. If you're paying in total more than 10 basis points-ish, maybe 20 basis points, I'll go that far, you need to make some changes. And by the way, also look at your monthly statements to see if you're getting charged like a quarterly percentage fee. It's usually quarterly rather than monthly, but sometimes monthly, sometimes annually, whatever. Some type of fee just for the honor of having that account. Add that up. That fee is going to be the one you're paying year over year. And by the way, each year as your investments go up, the fee goes up too.
Another thing to note with that, not all places are good about showing you the fees. So we like to use either Morningstar or YahooFinance, and you can search on those to look for your fee, like the expense ratio, front load, 12B1. So that is a good place to find it. We'll put links to that in the notes as well.
Yep. But really, add it up.
Yeah.
And if you're looking at it saying, wow, that's a lot of fees. Sometimes in your 401k, you can make changes. Sometimes you can't. I will look for Vanguard and Fidelity funds first in anyone's 401k because those are usually the lowest fees. You'll see some other funds that are pretty low fees. Cool. I'll also look at other funds and go, yeah, that one I know is going to have a high fee. Anything that's American funds, I'm going, that's probably a high fee. And you can buy that if you say there's a reason you're buying and paying that fee. You have to be able to say, this is why I'm paying that fee. And that's where most people just can't.
Yep.
That's all for this week's episode of Childfree Wealth Podcast. Be sure to follow Childfree Wealth on social media, email us at podcast@childfreewealth.com, or visit our website, www.childfreewealth.com.